Module Overview. Introduction. Accounting is often described as the language of business, serving as a systematic process of recording, summarizing, and communicating financial information. To understand accounting deeply, one must grasp the fundamental principles, concepts, and standards that govern the recording and reporting of financial data. These principles ensure consistency, reliability, comparability, and transparency in financial reporting, enabling stakeholders to make informed decisions. This module introduces the foundational concepts and principles that underpin modern accounting systems and provides an essential framework for all subsequent accounting topics. The purpose and role of accounting. Definition. Accounting is the process of identifying, measuring, recording, and communicating financial information about an entity to interested users. Users of accounting information. Internal users, management employees, external users, investors, creditors, regulators, tax authorities, customers. Objectives of accounting. To provide relevant and reliable financial information. To assist in decision-making, planning, and control. To ensure accountability and transparency. Accounting as an information system. Collects financial data, processes it into meaningful reports, and disseminates information. Fundamental accounting concepts. Accounting practices are based on certain assumptions and principles that guide the recognition, measurement, and reporting of financial transactions. These include 2.1 Business Entity Concept. The business is separate from its owners and other businesses, and its financial affairs must be kept distinct. 2.2 Going Concern Concept. Assumes the business will continue operating indefinitely unless there is evidence to the contrary. 2.3 Monetary Unit Assumption. Only transactions measurable in monetary terms are recorded. Assumes stable currency value. 2.4 Time Period Concept. Financial reporting is divided into artificial time periods, e.g., monthly, quarterly, annually, for reporting purposes. 2.5 Cost Principle. Assets and services are recorded at their historical cost, original purchase price, not market value. 2.6 Revenue Recognition Principle. Revenue is recognized when it is earned and realizable, regardless of when cash is received. 2.7 Matching Principle. Expenses should be matched to the revenues they help generate in the same accounting period. 2.8 Full Disclosure Principle. Financial statements should include all information necessary to understand a company's financial condition. 2.9 Conservatism Principle. When choosing between alternatives, select the one that is least likely to overstate assets or income. Accounting Standards and Frameworks. Generally Accepted Accounting Principles, GAAP. A common set of accounting principles and standards in the United States, established by the Financial Accounting Standards Board, FASB. International Financial Reporting Standards, IFRS. Global Accounting Standards issued by the International Accounting Standards Board, IASB, adopted by many countries worldwide. Conceptual Framework. A theoretical foundation defining the objectives of financial reporting and the qualitative characteristics of useful financial information, relevance, faithful representation, comparability, verifiability, timeliness, and understandability. The accounting equation. At the heart of accounting lies the fundamental equation. Assets equals liabilities plus owner's equity. Assets equals liabilities plus owner's equity assets. Resources owned by the business expected to bring future benefits. Liabilities, obligations or debts owed to outside parties. Owner's equity, the residual interest in the assets after deducting liabilities, representing owner's claims. The accounting equation must always remain balanced, providing a foundation for double-entry bookkeeping. Double-entry bookkeeping, a system where every financial transaction affects at least two accounts to keep the accounting equation balanced. Each transaction involves a debit left side and a credit right side entry. Rules. Assets, increase with debits, decrease with credits. Liabilities and equity, increase with credits, decrease with debits. This method ensures accuracy and helps detect errors. The accounting cycle overview. The series of steps to collect, process, and communicate financial information, including identifying and analyzing transactions, journalizing, posting to ledgers, Preparing trial balances, adjusting entries, preparing financial statements, closing entries. Common errors in the cycle, misclassification of accounts, omitted or duplicated entries, transposition errors, not adjusting for accruals or depreciation, forgetting to close temporary accounts. Understanding the why behind each step helps prevent these errors.